Hi everyone, here's what 99% of investors don't know about building wealth. While everyone's arguing about individual stocks, a small group of institutional investors is quietly building portfolios with just 10 ETFs that collectively manage over $2 trillion in assets. I'm talking about a strategy so simple that Vanguard's founder called it the greatest invention in finance since sliced bread. Yet so powerful that Warren Buffett bet $1 million it would beat hedge funds and won. Here's what blew my mind when I analyzed the August 2025 data. These 10 ETFs span yields from 1.3% to 13.92%, expense ratios from 0.03% to 0.68%, and have generated total returns ranging from 8.15% to 22.50% annually. Together, they create the ultimate diversified income and growth machine. But here's the crazy part. QQQI delivered a 16.44% total return while paying 13.92% in distributions. SPYI returned 12.71% with a 12.11% yield. These aren't theory. These are real money results beating traditional dividend strategies by massive margins. Here's the secret Wall Street doesn't want you to discover. The most viral ETF strategies aren't about picking the best fund. They're about understanding how these 10 powerhouses complement each other to create unstoppable wealth-building machines. Problem agitation? Problem number 1. There are too many ETF choices, I don't know where to start. Wrong approach. The paradox of choice is killing your returns. Solution number 1 for a beginner, start with the Big 3 foundation, VTI for total market, SCHD 3.72% dividend, and QQQ tech growth at 50-30-20 allocation. Solution number 2 is intermediate. Build the core satellite strategy using VTI 40% as core, JEPI at 20%, JEPQ at 20%, SCHD at 20% as income satellites. Solution number 3 is advanced. Deploy the barbell approach. 60% growth engines, QQQ, SCHG, paired with 40% income machines, QQQI, SPYI, JEPI. Problem number 2, I need income now, but don't want to sacrifice growth. This is where most investors get it backwards. They think it's either or. Solution number 1, beginner, the monthly payday portfolio. JEPI 8.3% yield, JEPQ 11.01% yield, QQQI 13.92% yield, all pay monthly. Solutions number 2, intermediate. Combine SCHD's 3.72% sustainable yield with SPYI's 12.11% high yield at 70-30 ratio for balanced income growth. Solution number 3, advanced. Use VTI as growth anchor, 60%, with covered call income overlay via JEPI, JEPQ, 40% for best of both worlds. Problem number 3, high yield always means high risk. These double-digit yields seem too good to be true. Here's what's crazy about modern ETF engineering. Risk management has evolved. Solution number 1, beginner. JEPI's 8.3% yield comes with 25% less volatility than the S&P 500 through sophisticated option strategies. Solution number 2, intermediate. JEPQ delivered 15.24% average returns since inception while maintaining 11% plus yields through covered call premiums. Solution number 3, advanced. QQQI's 13.92% yield is backed by NASDAQ 100 stocks with dynamic call spread strategies, not junk bonds. Problem number 4, these new high-yield ETFs seem unproven. What happens in a bear market? The data from 2025 market volatility proves these strategies work. Solution number 1, beginner. During Q1 2025 volatility spike, JEPI declined only 11%, while SPY fell 17%, buffered by monthly income. Solution number 2, which is intermediate, SPYI maintains notable outperformance within its covered call ETF peer group during enhanced market volatility. Solution number 3, advanced, higher volatility actually increases option premiums, boosting yields when markets get choppy. Problem number 5, I'm worried about missing out on growth while chasing income. This reveals the biggest misconception about modern income investing. Solution number 1, beginner. JEPQ tracks NASDAQ 100 tech leaders while paying 11.01%. You get Apple, Microsoft, Nvidia plus income. Solution number 2, intermediate. QQQI delivered 16.44% total return in past year while distributing 13.92% yield. That's growth and income. Solution number 3, advanced. Use correlation analysis. These funds maintain 0.85 correlation to indexes, but with enhanced income streams. Authority building. Let me destroy the myths with data that will change how you think about ETF investing. Stat 1, QQQI's 13.92% distribution yield plus 16.44% total return proves high income doesn't sacrifice performance. Stat number 2, JEPQ's 11.01% yield comes from NASDAQ 100 tracking with only 0.35% expense ratio premium management at discount prices. Stat 3, SPYI returned 12.71% total return with 12.11% distribution rate, outperforming larger peers like JEPI in net asset growth. Stat number 4, JEPI manages over $40 billion in assets as the largest actively managed ETF, proving institutional validation at scale. Stat number 5, SCHD's 3.72% yield costs only 0.06% in fees annually. That's $6 per year on every $10,000 invested. Stat number 6, VTI tracks 100% of the investable U.S. stock market with 0.03% expense ratio, while QQQ delivered 445% returns over the past decade. Stat number 7, the combined assets under management of these 10 ETFs exceeds $2 trillion, representing unprecedented institutional confidence. Stat number 8, JEPQ's 22.50% trailing return versus category average of 11.38% demonstrates superior option strategy execution. Stat number 9, FDVV pairs optimally with SCHD at 19% allocation, while VYM and SCHY provide international diversification under 0.25% fees. Here's what makes this data absolutely explosive. During 2025's enhanced market volatility, these sophisticated income strategies actually outperform traditional approaches while delivering monthly cash flow. Solution presentation. Strategy number 1, the never sell income machine. 30% JEPI, 8.3% yield, reduced volatility, 25% JEPQ, 11.01% tech-focused monthly income, 25% SCHD, 3.72% sustainable quarterly dividends, 20% QQQI, 13.92%, maximum yield with NASDAQ exposure. Target yield, 9 to 11% with monthly payments. Risk level, moderate, income focused with growth participation. Strategy number 2, the Millennial Wealth Builder. 40% VTI total market foundation, 0.03% fees, 25% QQQ technology concentration, 445% decade returns. 20% SCHD dividend foundation building, 15% JEPQ monthly income generation from tech leaders. Timeline 10 to 30 year wealth accumulation. Risk level moderate aggressive, growth with income safety net. Strategy number 3, the retirement income maximizer. 25% SPYI, that's 12.11% S&P 500 covered calls, 25% QQQI, that's 13.92% NASDAQ covered calls, 25% JEPI, that's 8.3% diversified equity income, 25% SCHD, 3.72% sustainable dividend growth, monthly income $900 to $1,300 per $100,000 invested, risk level moderate, high income with principal preservation. Strategy number 4, the International Diversification Master. 35% VTI, U.S. total market anchor, 25% SCHY, international dividend exposure, 20% FDVV, high dividend complement, 19% optimal allocation with SCHD, 20% VYM, maximum U.S. dividend yield coverage. Geographic balance, 60% U.S., 40% international alternative. Risk level, moderate. Balanced global income approach. Strategy number 5, the growth and income barbell. 30% SCHG, large cap growth, low fees, 30% QQQ, technology growth concentration, 20% JEPQ, 11.01% covered call tech income, 20% SCHD, 3.72% quality dividend growth, balance 60% pure growth, 40% sophisticated income. Risk level, aggressive, maximum long-term wealth building. Strategy number 6, the all-weather portfolio. 20% each of VTI, SCHD, JEPI, QQQ, and VYM. Equal weighting provides natural rebalancing mechanism, covers all major factors: growth, value, income, size, and geography. Rebalance annually or when allocations drift 5% plus from targets. The risk level is moderate, diversified across all investment styles. Close with urgency. Here's my bold prediction that's going to shock traditional finance advisors. These 10 ETFs will outperform 90% of financial advisor portfolios over the next decade while charging less than one-third the fees. Why you need to understand this revolution immediately? Reason number 1, the performance gap is widening. QQQI's 16.44% return versus traditional dividend funds of 8 to 9% represents a 7 to 8% annual advantage that compounds to massive wealth differences over time. Reason number 2, monthly income strategies are exploding in adoption. JEPI's assets grew from $17 billion to $40+ billion in 24 months as institutional investors discovered covered call efficiency. Reason number 3 is fee compression, which creates permanent advantage. These ETFs average 0.25% fees, while traditional advisors charge 1% plus. Over 30 years, that 0.75% difference compounds to over $300,000 on $100,000 invested. Reason number 4, options sophistication has democratized institutional strategies. What hedge funds charge 2% plus 20% for, you now access through ETFs for 0.35% annually. Your implementation blueprint starting September 4th. Week 1, analyze your current portfolio allocation and identify which of the 6 strategies aligns with your age, risk tolerance, and income requirements. Week 2, begin position building with the largest allocation ETFs first: VTI, SCHD, or JEPI, depending on the chosen strategy. Week 3, add complementary positions: QQQ, JEPQ, QQQI, while setting up automatic dividend reinvestment for maximum compounding. Month 1, establish systematic monthly contributions and quarterly rebalancing schedule to maintain target allocations through market cycles. Quarter 1, track performance against relevant benchmarks and document monthly income received versus traditional dividend approaches. The institutional revolution in income investing has already begun. SPYI outperformed JEPI during 2025 volatility. QQQI delivered 16.44% returns while paying 13.92% distributions. JEPQ returned 22.50% while maintaining monthly income streams. The question isn't whether these strategies will dominate, the data proves they already are. The question is, will you implement these institutional quality strategies before they become mainstream? Or will you discover them after retail investors drive up valuations? The $2 trillion in combined assets proves smart money has already made their choice. Your financial future awaits your decision. This analysis is for educational purposes only and does not constitute personalized investment advice. ETF investing involves market risks, including potential loss of principal. Past performance does not guarantee future results. Options-based strategies may cap upside potential while seeking to reduce downside risk. Consider consulting with qualified financial professionals before making significant portfolio changes, especially regarding retirement income strategies and risk tolerance assessment. Please like, share, and subscribe. Here's to your investing success. Profitable investing.